All right, let's talk about something that gets every options trader's heart racing: earnings season. You know the feeling, right? The excitement, the potential, but also the potential for some serious heartbreak. Today, we're going to build a practical guide for navigating these crazy waters, and we're going to tackle the single biggest trap that catches traders out. So, yeah, let's dive right in. And look, this isn't just some boring theory. This is happening right now. The market is bracing for a huge wave of earnings reports that are dropping tomorrow, so understanding what we're about to cover could make all the difference. I mean, just take a look at this lineup. You've got heavy hitters in cybersecurity like CrowdStrike, a key player in semiconductors with Marvell, and then you've got retail with American Eagle. It's a really diverse group, and you know what that means? Each one is a totally unique puzzle to solve. So you're looking at this list, you see a name you like, you've got a gut feeling about which way it's going to go, and you are ready to pull the trigger. But hang on. Just wait a second. There's this hidden trap that loves to snatch profits right out from under you, even if you guess the stock's direction perfectly. It's time to unmask the villain of this whole story. It's a phenomenon called implied volatility crush. We just call it IV crush for short. And believe me, this is the #1 reason why traders get absolutely burned during earnings season. So what in the world is implied volatility? You know, the best way to think about it is as the market's fear pricing. Yep, that's right. It's all the uncertainty, all the anticipation of a big move, and it gets baked right into the price of an option. And right before a huge scheduled event like an earnings report, this fear pricing goes through the roof. And here you can really see the two faces of IV. On one side, before the news hits, options are super expensive, just bloated with that fear premium. But the second that earnings report is out, poof, the uncertainty is gone, and that IV just collapses, and it absolutely kills the value of both calls and puts. That, my friends, is the IV crush in action. And this right here really gets to the core of why this is so dangerous. Just imagine this. You buy a call option, and you were right. The stock pops, but the IV crush is so brutal that it sucks more value out of your option than the stock's move actually added. So what's the result? You were right about the direction, and you still lost money. It's infuriating. So how in the world do we fight back against this thing? I mean, we can't stop the crash from happening. It's a force of nature. But what we can do is equip ourselves with a hero's toolkit of smarter trading strategies that are specifically designed to manage it. So here's the key takeaway. The answer isn't to just buy more options or pray for an even bigger move from the stock. Nope. The smarter play is to use strategies that define your risk from the get-go. Things like spreads or certain premium selling strategies that are built to handle or sometimes even take advantage of this drop in volatility. Think of this cheat sheet as your playbook. It's all about matching your view of the market to the right tool for the job. You think a monster move is coming, but you're not sure which way? A long straddle could be your go-to. If you're just kind of bullish and want to keep your costs down, a call debit spread is a perfect fit. And what if you think the stock's going to do, well, nothing? An iron condor could be the play. Let's break one of those down, the debit spread. It's a fantastic tool. So you buy an option to play your directional bet, right? But at the exact same time, you sell another option that's a bit further out. That sale helps pay for the option you bought, which lowers your total cost and, crucially, it defines your maximum risk. And here's the beautiful part. That IV crush that's hammering the value of the option you bought, well, it's also hammering the value of the option you sold, which actually helps you. It creates a cushion against the blow. Now, these strategies aren't magic, okay? It is so important to remember that IV crush can still have an impact on spreads. It's just a lot less dramatic. You still have to be careful not to overpay, and you always need to know exactly what your maximum potential loss is before you even think about placing the trade. And seriously, unless you are a seasoned pro, just stay away from those undefined risk strategies. Okay, we've got the theory down, we've got the tools. Now for the really fun part. Let's apply all this and actually build a game plan for 3 of those key stocks that are reporting tomorrow. First up, CrowdStrike. As a big name in the high-flying cybersecurity space, this stock is known for making some really dramatic moves after earnings. So if you're expecting that kind of fireworks show, but you're just not sure if it's going to go up or down, a long straddle or a strangle is a pure volatility play. It's designed to profit from a huge price swing in either direction. Next, let's look at Marvell technology right in the heart of the semiconductor sector.
Now, let's say you're actually feeling pretty bullish here. You think their report is going to be strong. A bullish call debit spread is a really precise way to act on that feeling. You get that upside you're looking for, but you do it with a locked-in, defined risk and a built-in buffer against the full power of that IV crush.
And finally, let's switch gears completely and talk retail with American Eagle. For this one, your theory might be totally different. Maybe you think the reaction is going to be pretty boring and the stock is just going to stay stuck in a predictable range. Well, a strategy like an iron condor is designed for exactly that scenario. It's a bet that the stock won't make a huge move, which lets you just collect the option premium as all that post-earnings IV evaporates. So there you have it. We've talked about the trap, we've got the tools, and we've walked through a few game plans. We've seen how to spot the risk of IV crush and how to use these defined risk strategies to deal with it. So the only question left is, as you look at that list of companies reporting tomorrow, which strategy best fits your view of the market?